Spring is finally here, and that means the real estate market is really heating up, and you might just be in the market for a place to call your own right away. That is why today we have a very special guest coming on to talk to us about mortgages. We have Stacey Shepherd from Dominion Lending Centers. Thank you very much for coming, Stacey. Tell us a little bit about yourself.
So I have been a mortgage broker since February 2014. I love what I do. I found that once me and my husband had paid down our mortgage really quickly, I found a love of mortgages and wanted to be able to help my clients out with that as well. I am a mom of 2 young children, so really understand the busy life that we all lead, and want to make sure that I can help out my clients and work around their schedules.
Awesome. Thank you so much for coming today. So, you know what? I often meet with buyers who really aren't very clear on different types of mortgages, or even some of the definitions tend to confuse them as well. What a term is, what amortizations are, and interest rates. There's different types of interest rates, variables, fixed, all sorts of things. So, I've got a couple questions I hope you can answer for us today.
For sure.
Yeah? Okay, so the first one we have, this is, what is the difference between a fixed and a variable mortgage term?
That's a great question. And those are really the 2 different kinds of terms that you can get for your mortgage. A fixed rate is the mortgage percent interest rate that you're going to have for that 5, 3, 7 years of your term. So that's going to be your actual payment every month. Lots of people like this because they want to know what their budget is and they want to make sure that they know their payment. The variable rate is usually a lower payment historically, but can increase and decrease over the life of your mortgage for your 5-year term. So it can be a little bit more variable, which is why they call it variable, but can be a little bit better rate-wise too for you, just depending on what you like.
So in what circumstances would you go for a variable rate over a fixed rate?
I like the variable rate for when clients aren't really sure what their next few years are going to be, either if they're going to refinance or going into, maybe they're thinking the next couple years they're going to move or not really too sure what that's going to look like. The variable rate's great for that because your penalty is really low for a variable rate. It's only a 3-month interest charge. So that's where we really like the variable rate is the unknown of mortgage life. Or if you want to pay your mortgage off really quickly, you can always go into a variable rate that you can lock in to a fixed rate at any time as well.
Right. So I would assume when you have a really good interest rate offered to you, at this time in the market, it would probably be best bet to lock it down, or would you say otherwise?
It's really hard to say, but really, everyone thinks that the rates are going to increase, and that the Bank of Canada is going to increase their rates, so probably going into more of a fixture. But right now, you could still go into a variable and wait and see what the market's going to do for the next few years and see.
Because you always have the option of locking it down.
Always.
I think that's a huge key. So you at least have the flexibility with the variable mortgage to say if things are starting to look like they're going up, you could always lock it down for future benefits.
For sure. And what I always see is that really you have 4 times for them to increase the variable rate for it not to be worthwhile in going into the fixed. So if you can think that might be another year or 2, maybe the variable rate's good for you.
Great, thank you. So why are there so many different types of rates for a 5-year mortgage? I mean, you hear all the time people getting, quotes of 3.4, 2.9, I mean, they're all over the place. Why is that?
Well, that's a great question. And our mortgage world has changed so much over the last year and a half. That's really why there's so many different mortgage rates. So whether your mortgage is insured, whether you have a variable or fixed rate, whether you've done a refinance, there's so many different reasons why there's lots of different rates out there. It's really, really important to make sure that you sit down with someone, a professional who knows why there's so many different rates and what that may be. I have clients who say, I was just quoted 2.9 from a bank or from this, and not really knowing what that entails with a mortgage is included. So it's good to know.
Because there's always different conditions attached
Yes.
to these different types of rates that different lenders would offer. And there's obviously different tiers of lenders. There's the big 5, there's the tier 2 lenders that offer different rates, but they're conditions are much different than they are.
Yes, and that's really why I loved Dominion Lending when I was first getting into the mortgage world, because we have over 100 different lenders that we can go to, lots and lots of different options. We have some of the major banks that we can go to as well, but there's lots of different mortgage rates out there. So it's really important to know what you're getting into, what the mortgage looks like, what all the different terms are, and to make sure you have someone to sit down and go through that with you.
Always a good idea to shop around a little bit, and sometimes your own FI would be the best option, but definitely go there first, but then do some other due diligence as well before you actually commit to one of their mortgages. So what's the difference between an insured mortgage and a conventional mortgage?
There's lots. So with the new mortgage rules, insured mortgage, that's when you have CMHC, Genworth, some of the major insurers that's tacked onto your mortgage. That's going to give you the lowest mortgage rates right now for the 5-year fixed terms. There's actually something else called the insurable mortgage. So maybe a few years ago, you got your mortgage, you didn't have your mortgage insured, so paid CMHC fees. Well, that's now called an insurable mortgage. So it can still fit into the mold of what an insured mortgage would look like. And now there's conventional. So conventional would be your usual 20% down, or maybe that's a refinance. That would be a conventional as well, or a 30-year term. So there's a little bit different terminology that we use now, but lots of different options in all of those realms.
Different ways you can structure the mortgage depending on what you're doing. If you're doing less than 20%, would that be the insured mortgage?
That would be insured mortgage.
And over 20%, that's a conventional. That's kind of a good rule of thumb to work with.
Yes.
Correct?
And sometimes too, for your conventional mortgage, you can still put 20% down and pay a little bit more for your CMHC fees and still get the best rates. And as we see mortgages coming over the next few years, new rules and stuff coming in, we're kind of thinking that might be the best way to go, is to pay a little bit more insurance, but you're guaranteed the lowest rates for your 25-year amortization.
Because at the end of the day, I think the interest rate is probably going to make the biggest difference in your overall payment of your house. Ultimately, you want that to be as low as possible, and even if you have to pay a little bit up front, I think it works out at the end where the lower interest rate always wins. Right? Yeah. Okay, so what then is the difference between an insured, excuse me, I got the wrong question there. What's the difference between an amortization term and the mortgage term? So there's the 5-year lockdown term that people talk about, and then often there's the mortgage life that is 25 years or 30 years. A lot of buyers actually don't really understand the difference, because it's just not something that's explained to us very well.
For sure. So the amortization is, I always say, people don't usually have your $300,000 to buy a house or $500,000 to buy a house. So we have to stretch that out over the 25 years, just to make sure that you can still survive and live in your house and do everything else that you need to. So that's your amortization. So you can go from 10 years if you want to pay it off really fast, and up to 30 years. There's still a few lenders that will do 35, but not many out there. And then the mortgage term is your 3, 5, 7 years that you want to lock in that rate for, whether that be variable rate or fixed rate. So that's more of your, every 5 years then you can renegotiate what you want your mortgage interest rate to be.
So it's the amortization essentially is the entire life of the loan, whereas the term is, think of it as kind of an option for you or the lender, at least some flexibility with a short period of time to renegotiate the terms of the whole loan.
Yes.
Great. Awesome, thank you. So I'm going to throw one last question at you here.
Please.
What do you think so we know with the stress test lately, with all the interest rates going up, and people having to qualify at 2 points above what they were getting already, what do you think that really tells us about going forward in the next couple of years for housing? Do you think, is there some sort of a consensus in the mortgage industry as to what that means, or potentially the direction where that's going?
I have to say, I ask a lot of lenders that I meet with what their views are, as well as my own, and they all think that mortgage rates are going to probably end up more around that 4%. Is a very comfortable, that they're very comfortable with, that they have to we have to qualify our clients on the 2 points higher than what the actual interest rate is, really tells us that they want to make sure that once interest rates start to rise, you can still live and survive in your house afterwards. So yeah, that's what I think that it's starting to show us, is that they're trying to get interest rates a little bit higher and make sure that we can still live in our houses.
It sounds like they're preparing the public for it, right? So that essentially they're telling you rates are going to go up, so you should be able to pay for it now if you're going to be able to pay for it 5 years down the road. So I think that's a pretty good rule of thumb to approach the whole mortgage thing at this point.
Yes.
Would you agree?
Yes, for sure. I think too that we want to make sure that you can get into your home and still live comfortably in it, and that's kind of where that stress test comes in a bit. We know that you're going to need a new car eventually. Heating, we only have to say that you pay $100 for heating, or you might actually pay $200 a month. So there's lots of different variables in there that we want to make sure you can still live and survive in your house.
You don't want to be house poor. That's what it comes down to, right? So, and I think when you guys are doing your total loan to debt ratio, that's where all the numbers will come in, and we'll have to work together to work with a new interest rate number that we're given. So,
yes, exactly. Yeah.
Great. Well, thank you very much. That was really, really informative.
Thank you. Thanks for having me.
I hope my clients will have some good questions for you in the future. So you should tell them how to get a hold of you.
I live by my phone, so you can always get a hold of me by calling, texting, email. My phone number is 587-783-2511, and email is stacyS@dominionlending.ca.
I will put it up on the video, so you'll be able to see it as well, and just copy and paste it into your email. Shoot her a quick email and get together. She'll be able to help you out. So there you have it, folks, from the Mortgage Jedi herself. Thank you very much for joining me today. Have a great day, and see you next time. Bye.